So you've probably seen him on crypto news lately. He wears a suit, he's got thick rimmed glasses, and makes extremely bold predictions. He's calling for Bitcoin to hit 200K by the end of 2026, and for Ethereum to be 12. If this rings a bell, you've likely come across Tom Lee, chairman of Bitmine Immersion Technologies. Today, we're unpacking why the community is calling Bitmine the MicroStrategy of Ethereum, and also their massive plan to accumulate 5% of all ETH. This is the AthenaX Whitepaper, strictly educational, not financial advice. So last week, Bitmine Immersion Technologies, a NASDAQ-listed company, acquired $195 million in Ethereum, adding to what has become one of the fastest ETH accumulation sprees in history. They've bought over 3.5 million ETH, having started just 4 months ago in July. Their treasury is now worth slightly north of $11 billion. With those tokens, they currently own about 3% of the supply of the Ethereum network. And this raises three big questions. What's their economic model? What are they doing with all of that ETH? And what's on their roadmap? At the front of Bitmine is Tom Lee, a Wall Street veteran who previously worked at JP Chase as the head of equity for 7 years. In 2014, he left to start his own financial research boutique called Fundstrat. He rose to fame in 2017 after predicting that Bitcoin would hit 55K in 2022, which it eventually did. Since then, he's doubled down as one of crypto's most famous permabulls. His recent predictions, though, they've been a bit spotty. But who doesn't love an internet personality, right? So he's fully doxed and leads Bitmine's treasury strategy. The rest of the team are also doxed, and they're mostly ex-Wall Street guys with experience in cross-border finance, and they deal with family offices in Asia and the US. So one can assume that they're connected to liquidity and they know how to use it. Bitmine's entire play rests on one key belief, that Ethereum will become the default blockchain for global stablecoin payments. Combine that with regulatory tailwinds like the Genius Act, and the thesis becomes simple. When stablecoins go mainstream, all of these payments will run on Ethereum. The gas consumption required to process these payments will explode, and this scales the prices of Ethereum upwards. Higher Ethereum prices turns Ethereum into a monster cash flow machine through its staking rewards. Now, if you believe that this is the future, then the obvious move is to own the underlying infrastructure at scale, which is why people like to compare Bitmine to MicroStrategy. Except instead of Bitcoin as digital gold, this is Ethereum as the global settlement infrastructure, or the new SWIFT. So does this actually help crypto adoption? And the answer is yes, but with caveats. If Bitmine executes its vision, they become the institutional proxy for ETH exposure. Institutions would no longer need to set up their own digital asset treasury. They can just buy the Bitmine stock through a traditional brokerage, and they'll get ETH exposure indirectly. And that shifts ETH ownership from crypto natives to traditional finance. For better or for worse, the ETH supply starts moving from crypto bros into the hands of finance bros. Bitmine buys Ethereum through ATM or at-the-market offerings. In plain English, they sell BMNR shares and use the proceeds to buy and stake Ethereum. So it kind of behaves like a yield-bearing token, but it's wrapped inside a public company. Through ATMs, they've earmarked about $24.5 billion worth of shares for Ethereum purchases. So far, they've raised $15 billion, which 11 has been deployed into ETH. If ETH's price go up, Bitmine's market cap and NAV rises. A higher net asset value lets Bitmine issue more shares at a premium. And because it's issuing more shares, this dilutes existing shareholders. But it also creates a sort of like reflexive flywheel. Sell shares to buy Ethereum, raise NAV per share to acquire even more Ethereum through the rewards, and attract more buyers who believe in the vision. Bitmine makes money from two ways: ETH staking yields and the share trading premiums on the MNAV. Ethereum staking yields generates approximately 4 to 6% APR, which, when you think about it, really isn't a lot compared to the other opportunities in the market. The real revenue for them is in those share premiums, and those increase when the price of Bitmine go up. If its MNAV is more than 1, newly issued shares on its ATM are sold at a premium, and the company gets to acquire even more ETH to increase the ETH per share value. Conversely, if its MNAV is less than 1, it signals that the share's market cap is below the ETH's treasury value. And that's not really good for people who believe in the stock, unless you are the guy that wants a depth on the balance sheet. At time of recording, Bitmine is trading at $28 per share. The MNAV is 0.72. So let's take a look at the risk here. The 0.72 MNAV reflects the market's dilution fears with the ATMs. Also, that is $4 billion in unrealized ETH losses since the October 10 liquidations. That's about 25% drop since last month. So the bear case is that investors, they're skeptical and they don't fully buy the DAT playbook. As for the bull case, there could be an undervalued opportunity here. And you're essentially buying ETH at a 20% discount, and a rebound on Ethereum would further amplify your returns on the yield and also the NAV. But hey, only time will tell if Bitmine becomes the new strategy. And that's really contingent if they own 5% of the ETH token network. In their latest investor report, they announced that their staking operations will go live in Q1 of 2026. With this comes the launch of the Maven network, which stands for the Made in America Validator Network. And that's going to increase the overall ETH staking annual rewards for everybody. We should also note that Bitmine has also been buying Ethereum religiously every week in every market condition since July in order to make this happen. Additionally, having 5% of the ETH token supply, Bitmine stands to position itself as a key Ethereum security provider and a big boy in Ethereum governance. Potentially, they could influence the whole network from the upgrades and through to the direction of Ethereum. Bitmine's strategy doesn't really stand out in a crowded DAT space. Everyone's strategy is the same here. Issue new shares to buy new assets, compound those assets into more staking rewards, and really build out your reflexive loop. But what maybe sets them apart is like how strategy has Michael Saylor, Bitmine has a Tom Lee factor, and that personality alone gives them significant attention and capital inflow from his popularity on Wall Street. So for final thoughts, I would place Bitmine share as more of a convenient debt tool to place on your balance sheet. As a retailer, I probably would not pay the premiums to buy the Bitmine stock just to have exposure on Ethereum, but I would spend a little bit more time to find out how to buy ETH myself and then to earn those staking yield rewards for free. But if you're an institution looking for a simple and compliant access to Ethereum exposure, which isn't going to be a headache for your finance and accounting department, Bitmine stock is probably the path of least resistance for you. That's it for this episode of the AthenaX white paper, and I'll see you at the next reading.